far as the eye can see.
The data from the US too, Stephen, has been a bit mixed over the last couple of weeks. We have had positive and negative data points. What's your call for the second half or the first half of the US economy?
I would put about a 40% chance on a double dip, which is an extremely high probability. We have a shaky recovery. Just printed a big number in the fourth quarter of last year, but two-thirds of that, nearly 6% gain in annualized GDP, was a temporary shift from the inventory restocking cycle. Final demand, especially consumer demand, remains subdued, is likely to be subdued for some time to come. And as a result, the derived demands for employment, capital spending are likely to be very weak as well. Unemployment remains exceedingly high despite the statistical aberration of a drop in the January figures. And American families, consumers, workers remain under very, very tough pressure. Double dip is a distinct possibility, in my view, in the United States at some point in the second half of 2010.
If that's your view on the economy, though, Stephen, where does that leave equity markets for this year? I mean, how high would you rate the chances that towards the second half, markets can actually recover the gains we saw in 2009 and deliver returns as stellar?
Look, the U.S. stock market, the Asian stock markets, European stock markets, Indian stock markets price themselves for a standard, classic V-shaped recovery with almost no possibility of a setback. I think the big surprise for 2010 will be a growth scare. I don't know if we'll have an outright contraction or a double dip, but I think to the extent that markets have ignored this possibility, it's going to be a much tougher year for world equity markets in 2010 than it was in the final 9 months of 2009.
Where does all that leave the commodity universe, Stephen? Up until now, things have more or less moved in tandem with the emerging market space and commodities. What do you expect to see in that asset class?
Commodities perform very well when there are expectations of open-ended, vigorous growth in global economic activity. If I'm right, world economic growth will recover, but very anemically, and it'll be much weaker than commodity markets need to sustain high prices. So I think we have been at the upper range of commodities, commodity prices late 09, and I think we'll trade in a narrow range, probably somewhere below where we are right now.
Let's talk about China for a bit. What's your stance on the kind of tightening noises that you've heard from China over the last month or so? Because that's had some kind of a denting impact on the commodities market.
China turned in spectacular growth in 2009, but it was growth that was manufactured by the stimulus package, where investment spending accounted for 70% of the GDP increase last year, and that was fueled by a record open-ended burst of bank lending. China sends some very clear signals that bank lending needs to slow, otherwise there'd be a worrisome deterioration of loan quality, and that investment can be expected to slow given the likely shortfall of bank lending as well. So Chinese economic growth is certainly going to be facing significantly different headwinds in 2010 than it did in 2009, with important implications for China's Asian trading partners, especially in Eastern Asia.
Closer home, we've had some tightening signals as well from the Reserve Bank of India. How have you read the CRR hike, and do you think we are embarking on a long cycle of tightening or not quite?
Well, I think the RBI has been in the forefront of central banks around the world in using monetary policy preemptively to avoid and temper the risk of financial instability. This was certainly true in the period leading up to the bursting of the subprime bubble. And I expect the RBI to remain vigilant to the possibility of financial instability, inflation risk, and the like. Right now, the Indian economy is in pretty good shape, but should there be worrisome developments on either the inflation or financial instability front, I would expect the RBI to move quickly.
At your last India interaction, though, Stephen, you made the point that you had now decided on a huge shift after many years where you favored India versus China. What would you advise then as that India versus China call right now?
I would prefer to say that it's not either or, that I think you can be very constructive about India and China. These are two different countries. You don't want to paint them with the same brush, and I don't think you want to set up a horse race. China has opened up such an enormous gap in terms of per capita income relative to India over the past 19 to 20 years that it's inconceivable to me that India could close the gap. But I think the story for India is a very compelling one over the next several years. The micro in terms of companies, the labor force, financial institutions remains very positive. The macro in terms of saving, foreign direct investment and infrastructure has improved a lot in recent years. And the political constraints certainly look a lot more worrisome in the aftermath of the elections of last May. So I'm very encouraged by prospects in India, but I'm also very encouraged by the possibility that China is going to move ahead with a different approach to economic growth over the next few years than we've seen, focusing more on consumer-led growth dynamic, and I think that's equally good news for China.
Just to labor that point on the currency front for a bit, though, Stephen, there has been an extremely strong recovery for the dollar index. It's now trading at about 80. What are the chances it retraces to where it started from, i.e. the 73, 74 mark? And what kind of collateral damage would that have for our own currency, the rupee?
I do not want to get into a view on specific currencies in the region. I have learned that whenever I say anything about any currency, somebody, whether it's you or someone else, comes back and tries to embarrass me about it later. And in my life, making forecasts is embarrassing enough without stumbling into the currency trap.
We will leave it at that then. Stephen Roach, many thanks for joining in. The Morgan Stanley conference as well kicks off, and that is Stephen Roach talking about how he's viewing this entire space. Prepare for a lot of volatility this year, especially from the US. Let's take a break.